Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last lecture, we overlaid moving averages directly onto our price chart to find the macro trend. But what if we want to measure the exact velocity of that trend? We cannot just look at lines on a chart. We have to extract those moving averages and mathematically measure the distance between them. Today, we are master the ultimate momentum oscillator, the MACD, or moving average convergence divergence. Now let's look at the trading app. So how to find the MACD? You just need to search it from this indicator and type MACD. Then you click it. Then you can see this MACD right here. So you can basically make it larger to see these lines, the curves, and the histograms. And here's the MACD. If you look at the settings, right, you will see the default numbers 12, 26, and 9. Why do we use those specific numbers? When Gerard Peel invented the MACD in the 1970s, the stock market was open 6 days a week. So 12 days represented exactly 2 weeks of trading. And 26 days represented exactly 1 month. Today we only trade 5 days a week, but because of institutional inertia, the massive algorithmic trading bulls never updated their settings. As quantitative traders, we must use 12, 26, and 9 because we have to look at the exact same signals as the smart money. Okay, before we talk about strategy, we have to talk about how your trading app displays this math. Because it is incredibly confusing. If you use an app like Momo or Weibo, you don't see the Western terms MACD line and signal line. You see DIF, okay, the orange one, and DEA, the blue one. Okay, and then you see an MACD appear here. The DIF stands for difference. It is our first line. The raw mathematical difference between the 12-day EMA and the 26-day EMA. The DEA stands for difference exponential average. It is our slow line, a 9-day average of the DIF itself. But look at this MACD from a trading terminal. Notice that the word MACD is on there twice. The first one just labels the panel. The second MACD value actually represents the height of the histogram bars. Apps calculate this by subtracting the DEA from the DIF and multiplying by 2. If we do the math on this exact screenshot, 4.7 minus 1.7, which equals 3.0, multiply by 2, and we get exactly 6.0. Okay, so the definition also shows here, and here was the note. Finally, we have the 0 axis, which is the flat baseline at 0. Okay, so it's this line right here. Okay, now, how do we actually read this to make trading decisions? First, we look for crossovers. When the fast DIF line crosses above the slow DEA line, we get a golden cross. And the histogram violently flips from red to green. Think of the DIF as the stock's current speed and the DEA as its average speed. If your current speed crosses above your average speed, you are actively accelerating. In the stock market, upward acceleration requires force. A golden cross proves that urgent buying pressure has overwhelmed the sellers. Conversely, if the DIF drops below the DEA, that is a death cross. The momentum has factored selling pressure is accelerating, and we need to exit or long position. Let's see this example. You see this orange line is the slow line, is the fast line, and then blue is the slow line. So here we have a golden cross, death cross, then golden, death, golden, death, etc. Okay, now let's get back to this. But why we do not just wait for crosses? We watch the histogram energy decay. If a stock is rising, but those green bars start shrinking, the upward momentum is decelerating. The market is stagnating, warning us of an imminent pullback. If the stock is falling, but the red bars start shrinking, the downward momentum is exhausted, and a rebound is likely. In this example, we see that the green bars decreases right here, and for red bars, we can see some shrinking right here. Okay. Now, let's talk about the zero axis. Okay. The reason is that this is where retail traders lost their capital. What does being above the zero line mean we are in a bull market? Let's look at the math. For the DIF to be strictly greater than zero, the 12-day moving average must mathematically be higher than the 26-day average. As we established last lecture, a short-term moving average trading above a long-term moving average is the exact definition of a bullish alignment. Above zero means we have a macro bull trend. Below zero means a bear trend. And if we are mixed, one above, one below, the trend is actively transitioning and we wait. Retail traders love trying to cash absolute bottoms, but they eagerly buy golden crosses that happen below the zero axis. Do not do this. It is a trap. Why? Because of overhead supply. When the MACD is below zero, the fast moving average is trapped below the slow moving average. Psychologically, this means thousands of retail buyers are trapped holding heavy losses. Every time the price attempts to bounce on a below zero golden cross, those trapped buyers aggressively sell their shares just to break even. They create a suffocating ceiling of resistance. We call this a dead cat bounce. And the failure rate is simply too high. We veto this step setups entirely. Now, before we get to our secret weapon, a professional quantitative trader must know the limitations of their tools. Because the MACD is fundamentally derived from moving averages, it poses an obvious inherent limitation lag. Never use it on an intraday chart. The short-term noise will give you relentless false signals. Furthermore, if a stock is trapped in narrow sideways chop, the MACD lines will tangle together and become useless. It requires sustained trends to function properly. Knowing those limitations, how do we use MACD most efficiently? We use it to hunt for top divergence, also known as bearish divergence. This occurs when the geometry of the price chart fundamentally contradicts the math of the MACD momentum. Look at this chart of Microsoft from July 2025. Driven by FOMO, retail bears pushed the stock up to a massive new all-time high. But look down at the MACD. Well, the price made a higher high. The DIF and histogram made a definitely lower high right here. When this happens, the market must resolve the mathematical contradiction. Either a massive surge of volume has to flood in to repair the math, or the price will collapse. As you can see, the momentum broke, a death cross printed, and the stock violently crashed in August to realign with the exhausted momentum. Okay. Finally, how do we integrate this into our afternoon golden window? We only trade when the DIF and DEA are strictly above the zero axis. If a stock is in a macro uptrend and it pulls back to a valid structural support line, we watch the MACD. The exact afternoon, we see a golden cross print combined with expanding green histogram bars. We execute our long position. The MACD perfectly measures momentum velocity, but it cannot tell us when an asset is mathematically overbought or oversold. To define the absolute limits of human emotion, we need to add one final oscillator to our trained engine. In our next lecture, we are diving into the RSI. See you in the quant lab.